makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Guy Johnson. Francine is out today. We've got some data that's also out today. So let's talk about what we're seeing with the numbers. We've already had French PMIs. We've now got German PMIs to digest. And then we get the aggregate Eurozone number. The manufacturing number, a little weaker than anticipated here, folks. 45.6. That's down from 45.8. It was expected to pick up. Look at the German number. It is ugly this morning. The services number, 51.9. Again, that's softer than anticipated, but still at least in positive territory. That takes the composite number to 50.1, i.e. absolutely flat between contraction and expansion. And we were expecting, again, that number to be a little bit more positive. So that's the picture. You see the reaction in the euro this morning. I need to talk a little bit about what's happening with the dollar more broadly, though, because the dollar is a risk-off story this morning. You're going into the dollar as a result of that. Why are you seeing risk-off? Well, you're seeing risk-off because you've got Alphabet numbers, which didn't go down very well last night, despite actually being better, and the Tesla numbers really weren't pretty at all. So let's take a quick look pre-market at what those stocks are doing, just to give you an idea of what they look like. And as you can see, it's not exactly a magnificent start to the earnings season for the Magnificent Seven. Alphabet's a little softer, down by 2%, but look at what is happening with Tesla this morning. It is down by circa 8% as we head into the open of US trading a little bit later on. CEO Elon Musk, obviously the front man for this in the earnings season, and patience was once again apparently a virtue. He was talking through his plans for the Gigafactory in Mexico, and this is a political story as well. This is a Trump story, and apparently that is on pause.
Giga Mexico, I think we need to see just where things stand after the election. Trump has said that he will put heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico if that is going to be the case.
Elon Musk needing a little bit of an energy boost, you kind of felt on that call last night. We have got lots to discuss, and we've got the perfect people to do that. Joining us around the table this morning, Johanna Kyrklund from Schroders. She's going to give us the big picture story. What do you do with all of this? How do you fold it into your portfolio? Let's talk about the details of what we learnt last night and work our way through the Magnificent Seven. We've got Tesla and we've got Alphabet. Kriti's continued with me after the last programme around the table. Craig's back to talk about it. Craig Trudell, our car czar. Craig, let me start with you. There was lots not to like last night, but was any of it really new? The robotaxi we're going to have to wait for. The robot we're going to have to wait for. Investors are being asked for patience once again, but it kind of feels like that patience is wearing thin.
Well, it's a bit of a, live by the robotaxi, die by the robotaxi here, where, the anticipation of that unveiling, despite the fact that we are talking about just prototypes, it's very unclear just how, ready this product is for prime time, how soon regulators are going to give their blessing. But this is something that really just drove an incredible rally in the shares. The last time this company was reporting earnings, they were down more than 40% for the year. They had come all the way back from that, largely, I would say, on the basis of optimism about autonomous vehicles and AI. Musk was really successful in really sort of tethering the stock to, the AI optimism. And, we've seen now that when Bloomberg first reported that this event was going to be delayed, the stock had its worst day since January. It looks like we're headed for another rough day on the basis of maybe putting some more risk onto that opportunity.
Kriti, the funny thing about the Alphabet numbers is they were good. But the AI story we're talking about with Tesla is one that we're going to have to wait for. The call was about AI. It wasn't about sales. It wasn't about advertising. It wasn't about cloud. And the market seems to, because of the way the stock has kind of been pushing higher, the market needed to hear a positive AI story.
So good numbers, but not good enough numbers. And I think Alphabet in particular is really trying to use Craig's exact phrasing, tether itself to the AI story. But it's not an AI story yet. It's not even a cloud story yet. It is still an advertising story. It is still a YouTube is weighing on the numbers kind of story. And the advertising numbers were interesting. They came in at about 11% a jump in revenue. But that's a deceleration from the previous quarters, at least the analyst community pointing that out. I think what was interesting is and I think the context is important here, Microsoft Azure and Amazon Web Services has the dominance in this market. Oracle's trying to break into it. Alphabet's trying to break into it in terms of market share. They're throwing a lot of money at this, and they're not able to get there yet. And that's where it's very clear. They're saying, be patient, look at the future, we're going to grow. But again, when it comes to the actual metrics of what they're up against, they don't have much to deliver just yet on that front.
So we need more patience. That seems to be the overriding narrative.
Channeling Jay Powell.
yeah, exactly. Just wait. We'll be data dependent. Unfortunately, the data maybe not from these tech companies looking that good. Guys, thanks very much indeed. The Tesla, the Alphabet story. Obviously, we're going to continue with the big tech story. I want to hear from NVIDIA and see exactly what it has to say. There's a lot of spending going on. Is it, to Kriti's point, actually delivering? Johanna Kyrklund, co-head of investment and group chief investment officer at Schroders, joins us now to give us a take on all of this. If I've wanted to outperform in my portfolio over the last few quarters, I've needed to be long big tech. That has been where the outperformance has really come from. Has that period come to an end? And if so, as an investor, what do I do with that?
Well, I think, certainly over the last few quarters, that's been the epicenter of return. But there have been a lot of other return opportunities across the world, actually. So generally, we've favoured equities.
Yep.
And, Japan's been a great story. We had a bounce in China. There has been a lot of other things going on as well. And I think at this point, it's again about focusing on the fact that nominal growth is still quite strong. Rates are coming down. So the big picture for equities is still supported.
But if I've had a diversified portfolio, I have underperformed over the last few quarters. The data's pretty clear on that. Are we going to see a diversified portfolio doing better now?
Potentially, because I think the valuations are very supportive as you go down the cap spectrum. There's a lot of pent-up return potential. We've seen that rally in US small caps. We've also turned more positive on UK mid caps. Now we've got a bit of political stability.
Yep.
So yes, absolutely, the valuations there are still supported.
So what is the potential? Let's take UK mid caps. What is the potential upside there? How the gap is enormous. The spread is historically large. How much can that close?
Well, I think the key thing is not to try and go long mid-caps versus large caps necessarily.
Okay.
We're generally overweight equities. I think that's the key. And again, it's about a very benign growth environment still. We're still in a soft landing. And I think people are still underestimating the benefit of that growth environment for equities more broadly.
But the UK is a beacon of stability right now, ironically?
It is, ironically, but I think we just went into our instability earlier than everybody else, and we're sort of coming out the other side. And, of course, international investors are attracted to the valuations in the UK.
So does the pound go higher on this? People are kind of wondering how much sustainability there is in this sterling story.
I think potentially sterling is still well supported, which of course is a bit of a headwind again for the FTSE 100 because of the overseas earners. But yeah, generally I think the UK story is quite a positive one in a world where there's still quite a lot of instability.
So in terms of how I think about where I want to invest, is it I've got weakness in Europe because of the China story and what is happening with luxury, and you can see that in the manufacturing story. I've got uncertainty in the United States. Does the overweight equity story work in an increasingly uncertain world?
Well, I think that we need to make a distinction here. I think that certainly Europe, the data has been softer. We're seeing a global manufacturing recovery, but Europe is underperforming on that front.
Oh, yeah.
When it comes to the US, yes, of course, the election creates a lot of uncertainty as we head into the autumn. But again, I think that growth is stable in the US. Inflation's moving in the right direction. We think the Fed can start to cut rates later this year.
So the rate cut story is the catalyst.
And I think that's important, yes. Again, of course, the election is hugely important. But I think, again, we also have to look at fundamentals, and fundamentals are still pretty strong in the United States.
So what do I need to see on the rate cut story to keep me on the front foot, to keep me risk on?
For equities, what's been priced in by bonds for this year is still absolutely fine. So 2 or 3 rate cuts is actually, I think, all that equities require.
OK.
The challenge more is potentially for bond investors, because actually where we disagree with the curve is when we look into 2025, we have more rate cuts priced by the curve, by the Fed in 2025. And I think there the market might still be a bit complacent. We've seen bond investors attempt to price a sort of more aggressive Fed pivot a number of times.
Oh, yeah. Yep.
And generally we think that, again, we're in a different kind of regime. And for that reason, I think that, again, I favour equities over bonds at this point.
But in terms of how we invest in equities, is the S&P has outperformed the S&P equal weight by a massive margin. Do I pivot out of the S&P into the equal weight? Do I look for the more diversified indexes that give me a better diversification story? Is that where I want to be thinking about putting the money rather than more concentrated indexes. The S&P traditionally has been kind of not seen as one of those, but has increasingly become one of those.
Actually, for now, we're still, to the extent we're overweight equities, we're doing it via the S&P 500. We haven't started to buy the Russell 2000 yet. Our stock pickers might be finding opportunities.
But even with the S&P, you don't have to buy the S&P. You can buy the S&P equal weight. You can buy the more balanced S&P portfolio. Because so many of the S&P stocks have not performed. But if the expectation is that they are going to perform, that we are going to see this broadening out, is that the way to go? You don't even need to go down into the Russell.
I mean, we've looked at the equal weighted again. We haven't acted on that yet because I think that actually there is still enough support. We still have a few more earnings to go with the tech sector. We'll see how those pan out over the next few weeks. But ultimately, I think that it's potentially too early to start underweighting those stocks.
Yeah.
And therefore, for me, I think it's still the S&P 500. And there's enough under the surface of the S&P 500 to support the market as long as those stocks are stable.
OK. In terms of how I want to think about a portfolio, is it 60-40? Are we back to thinking about that? In terms of the kind of portfolio construction you're looking at right now, how different is it versus where we were even a few months ago? How am I thinking about the relative weightings that I've seen? You are obviously overweight equity, so that doesn't necessarily apply. But in terms of the way you're thinking about how the ratios work within the portfolio, what does it look like?
I think there are a number of things. I think, first of all, people have sort of been... After 2022, everyone's like 60-40 is dead. I think it's still a completely viable strategy. Equities for growth, fixed income for the old-fashioned reason, which is for yield, not for diversification. And that's going to work, is it? For yield. Yeah. And it means you need to recalibrate the yields at which you're willing to own fixed income. But I think that it still has a role to play. I think the big difference relative to the last decade is you also need to consider allocations to more inflation-beating assets. Things like commodity-related investments, for example, are more interesting than they were in the last decade when we were facing deflationary headwinds again and again. Now, I think it's much more about, if you're looking for diversification, you own commodities.
And in terms of that diversification, what is a reasonable rate of return now? What am I thinking? I can still get 4.5%, 5% on cash. How much am I going to beat my cash portfolio into that diversified portfolio?
Well, again, I think we're seeing, if you look at bonds are more challenging because of the inversion of the curve, but ultimately expecting rates to come down. And again, there's still enough return potential in equities to beat the cash rate. So I definitely would be advocating getting out of cash.
OK. It's been great to see you. Thank you very much for stopping by to see us. Johanna Kyrklund, co-head of investments and Group Chief Investment Officer, joining us from Schroder's. Equity markets this morning certainly under significant pressure. We are seeing that tech story being folded in. We are seeing the luxury story being folded in. We're also seeing the banking story being folded in as well. Deutsche Bank is under real pressure this morning. Its shares are down significantly. First quarterly loss in 4 years. It's also about the return of money to shareholders. It's the Postbank story. We need to delve deeper into what is happening with the banking story. We will do that next. This is Bloomberg.
For this year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, $1.3 billion to $1.5 billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
The CFO of Deutsche Bank speaking there in conversation with Bloomberg's Ollie Crook. Deutsche Bank under significant pressure this morning. Let's delve into the details of what is happening, A, with Deutsche and B, with the wider banking sector. Bloomberg's Jenny Serrain joins us now on set. Nice to see you. Why is Deutsche Bank down as hard as it is?
I think, this is a quarter where they had this one-time loss. Even though folks kind of expected it, it even came in at the size that folks were expecting. They weren't expecting it to kind of impact the ultimate shareholder buybacks and kind of that capital return. And so a lot of times I think investors are willing to look past these little one-time items if it doesn't have that kind of farther-reaching impact. But when you heard, the CFO just there saying, I don't think we're going to go back and ask for another authorization, that's the kind of thing that gets folks worried that, longer term, is this going to weigh on their ability to kind of keep being a high-returning stock for us? So I think that's really what it came down to this morning.
And the market clearly taking that on board. BNP equities, wow.
It was a surprising quarter for them, right?
Yeah.
I mean, I think it's sort of interesting because very rarely do you get the kind of satisfaction of talking about political volatility so much and then seeing it kind of show through in the results so immediately. But yeah, this was the first time that their equities traders outperformed their fixed traders. And I really do think that all boils down to the political volatility that we've been seeing.
So is that sustainable, I guess, is the question that investors probably are going to be asking?
Yes, I think that's why you see them not kind of having this outperformance today. Trading results often don't get the kind of credit where credit is due when it comes to shareholders. It isn't sustainable usually. You have these really lumpy quarters where things can look really good and then look really bad. You often hear banks talk about the year ago being super good, and that's why this time is super bad. And so you sort of get that kind of narrative around trading results. But for sure, I'm sure there's some stock traders over in Paris today that are feeling really good about themselves. So.
Well, they can enjoy the weekend of sport coming up with the Olympics. Santander's higher. You talk about the kind of the lumpiness. This is the kind of almost the exact opposite, you would have thought.
I think that's right. You know, this is a bank that's really showing off the kind of strength of banking today. So when you think of banks, you think of taking deposits and making loans, and that's where they really outperform. So for as long as rates are still high around the world, that will still perform well. What I think you now hear investors asking is it sustainable as rates start to come down? And do they have the kind of non-interest income, those fee-based businesses that can kind of rev up in times where interest rate might start to fall? And so I think that will be the discussion over in Spain today.
But it's interesting that there's such big geographical diversity for that bank as well. Huge footprints in South America.
Yeah, absolutely. And so I think that's also where, you know, you kind of see a very clear line on what the ECB is doing and everything here in Europe. Is it the same line in LATAM and Central America? And so I think that will be something that those guys have to.
So we've had UniCredit as well out this morning. Got a whole range of banks. Pull it all together. What does it tell us about the European banking story in the second half?
It's really hard. I think today it's hard to kind of draw one straight line across because one area where we did see sort of cohesion was investment banking. So you really saw capital markets start to come back to life. You really saw advisory do well kind of across the space. And we saw that with the U.S. banks as well. So you had the similar story at Goldman Sachs, J.P. Morgan, Citigroup earlier this month. What I do think investors will start to ask is that sustainable? You know, just like what we talked about with trading, investment banking is often seen as lumpy. I do think that in general we've been in a period of just really, you know, a deal-making slump, very little capital markets activity at all. So on that front, there should be a little bit more, you know, room to run, as it were. But is this sustainable? So will we see these kinds of increases in the third quarter, in the fourth quarter? Or was a lot of this activity just clients pulling forward what they would have done in the second half and sort of leaving the second half?
Because of the U.S.?
Yes, I think so.
Yeah.
I think the election story in the U.S. really has, you know, a lot of clients looking and saying, okay, I was going to refinance in November. Maybe I should just go ahead and pull that forward. And that means that, you know, while debt capital markets looked really solid in the second quarter, do they still hold up in the back half? I think that it still remains to be seen.
There's a lot of imponderables in the second half. Jenny, great stuff. Thank you very much indeed. Bloomberg's Jenny Serena. What's happening with the European banking story this morning? Up next, we're going to take a look at some of the big movers. It's a busy morning. We need to show you some of these. You've got a lot of kind of mixed messages coming through from markets today more broadly. We'll deal with the details, the banking sector, the luxury sector, what's happening with the markets more broadly as well, with the tech story being folded in. We'll do that next. This is Bloomberg. Let's get you up to speed with what's happening with these markets this morning. There's a bunch of European movers that are really worth focusing on. Deutsche, we've already referenced, down pretty hard. We've discussed the reasons for that with Jenny Serena. LVMH is under pressure, as you can see, down by over 5%. That's dragging on the luxury sector. That's dragging on the CAC 40. Carole Madjo is going to be joining us very shortly to walk us through that story. EasyJet is up today. However, I would just say look at the 5-day chart on that. Basically, what we've done is fill the gap that we saw develop earlier on the week when Ryanair warned. So we're basically back to flat on the week, or maybe just a little softer than that. But that's what the EasyJet picture looks like as well. And Reckitt Benckiser out this morning talking about a strategy update, talking about spin-offs. The market seems to like what is happening there. Alphabet, Tesla, pre-market. Quick look at what is happening there as well, just to show you what the numbers look like coming out of the States already this morning. A fairly negative picture, certainly for Tesla. And we are watching. These boards will update, I promise you, at some point. And the dollar is also up this morning. Risk off, plus also the poor European data. Anyway, we'll talk luxury in a moment. We'll get back to that story. This is Bloomberg. Good morning. Welcome back. You're watching The Pulse. I'm Guy Johnson in London, in for Francine Lacqua. Need to get you up to speed with the top stories. Let's do that right now. Tesla profits falling short again. Elon Musk calling for investor patience. Alphabet CEO also asking investors to wait a little longer for some results from their big AI investments. Deutsche Bank plunging after suffering its first quarterly loss in 4 years. It's booking a charge related to Postbank. BNP Paribas numbers look really strong. Equities have been really strong there. Equity trading. Santander lifting its revenue guidance. Plus, we need to talk about what's happening with the luxury space. LVMH under pressure. China's luxury slump hitting sales of expensive fashion and drinks. We're going to talk about that story in detail in just a moment. The big story in many ways, though, this morning is the economic data. There's lots of kind of equity stories that we need to focus on as well. But you see some really surprising PMI data out of Germany this morning on the manufacturing side that is super weak. And when I say super weak, I mean really, really weak data here. It was expected to pick up. That has basically cast a shadow over the whole of the European Union. And now we get the data out of the UK. So let's fold that into the story as well. So manufacturing out of the UK, better than anticipated. Haven't seen that across most of Europe this morning. We are seeing it, continuing to see it here in the UK. 51.8, that's up from 50.9. That was above expectations at 51. The services line comes in better than anticipated. No, better than the previous number of 52.4, 52.5. So we're in the margin, I would have thought, there on the services line. That takes the composite number here in the UK, which is really standing out versus the rest of Europe, 52.7. So the numbers in the UK are getting better. The numbers in the rest of the in the rest of Europe, in the Eurozone in particular, are getting worse, particularly led by the manufacturing story. Let's pull it all together. Let's try and get an understanding of what is happening here. Zoe Schneeweiss joins us now to give us a take on the picture. Zoe, I want to start with that German manufacturing number. Why so bad?
Yes, that German manufacturing number really is quite dreadful. German manufacturing has been under that vital threshold of 50 for 2 years now. That obviously kicked off because German industry was so reliant on cheap energy from Russia. And as we know, that no longer is an option for Germany. Additionally, we do have the impact from China. Germany is an export powerhouse. A lot of those exports go to China. If China does badly, Germany will do badly as well. So part of this is just cyclical. The other issue is, though, that a lot of this is systemic. Germany very much focused on petrol cars. Now we've got the era of EVs. Germany obviously was late on that. Generally, Germany just needs to revamp its economy, and now for 2 years or 2.5 years has just failed to do so. And the prospects and then the ones outlined in these PMIs today don't make the situation look like it's going to get any better anytime soon.
Compare and contrast France and Germany for me.
Yeah, France has the advantages. It's not quite as reliant on manufacturing. It's more reliant on services. And France is just about to kick off the Olympics. So that's obviously a great thing for services. A lot of people are traveling there. You overall get this boost in the services sector. So that's good. France also, this time, for the first time now in months, the composite number was stronger than that for Germany, both of them in contraction, but France really edging toward that vital 50. That's, again, all down to services. Manufacturing in France still is bad, but they have the advantage here that they're just not as reliant as the German economy is.
Zoe, Lagarde talks at the last meeting of the September meeting being wide open. Does the German data make it even more wide open?
The data, the PMI data, and obviously Lagarde doesn't just look at Germany, although the ECB is based in Frankfurt. It looks at Eurozone as a whole. The Eurozone as a whole just barely grew. It came in at 50.1. That's way lower than economists expected. Economists had expected 50.9. That would have been steady from June's number. So, but still, this drop in economic output, or slowdown in economic output, is something that typically would mean that those calling for a rate cut would get backing. However, we also have to look at the price inputs. The ECB does not have a growth mandate. It does, however, have an inflation mandate. And the numbers we get from the PMIs, from the private sector, are that input prices actually are increasing and output prices are hardly shrinking. So that does look like there's going to be a sustained pressure in inflation. And while that means probably a September cut is possible, let's see what happens after that. The ECB has warned that there's going to be a bumpy road on inflation, and they only predict that the level of 2%, that 2% goal, will be achieved in the fourth quarter of 2025, so quite a time away. But overall, the price numbers we get from the PMIs are not encouraging.
Sorry, certainly not. Thank you for the analysis of the data this morning. That German number, just absolutely horrible in terms of its indications for the wider Eurozone and what it's telling us about Germany and China and that relationship too. Zoe Schneeweiss joining us out of Frankfurt on the numbers. Let's talk about one of the other big stories that we're watching out of Europe so carefully this morning, and that is the impact we're seeing on LVMH after its numbers last night. Sales growth at the luxury powerhouse slowing last quarter. Wealthy shoppers, particularly in China, reining in spending on LVMH handbags. We've seen Christian Dior under pressure this morning as a result of that. Later today, investors are going to be looking at Kering for the latest on its brands, what's happening at Gucci. You've got the drinks business as well. You've got Pernod out. You've got Remy out this morning. I forget which one, out with numbers as well this morning. The other story I want to talk about as well is what's happening in Japan, which is an FX story. We've got lots to talk about. We've got the perfect person sitting next to me here in the studio to discuss all of it. Barclays Head of Luxury Goods Research, Carole Madjo. Good morning.
Good morning. Thanks for having me.
Give me the top-down story on LVMH. What do you make of the numbers? What should I be taking away from it?
Yeah, so LVMH, it was a miss, of course, on both top line and the EBIT level. So on top line, I think all the key divisions, fashion leather goods, wine and spirit, watch and jewelry were a bit weaker than expected. And of course, the key division FLG, so fashion leather goods, we have seen top line being at up 1% versus around 2% of the expectation. So just a slight miss at the top line level. So here, by the nationalities trend, we have the Chinese being a bit weaker compared to the first quarter. So it was still positive, still growing, but at a slower pace compared to the first quarter. But on the other way around, we have seen the American cohort and the European as well getting a bit better here compared to Q1. So kind of a different, trends by the key nationalities. But of course, net was still, I guess, a bit weak. Same thing for the EBIT level. We have seen here as well a miss on FLG. So it was again still weaker. And I guess the key focus was also on the outlook. So how to think of H2, both top line wise and margin wise. And I feel like here on the call, there wasn't that much reassurance from the CFO around how to think about that for H2. So I think, there was a lot of still concern.
Is it the numbers
here.
of the call that's giving you the greater level of concern?
I think it was really both. On the call, they talk about, I guess, to start with the top-line level. There, of course, we have still a low level of visibility on how to think about top-line growth in H2. Yeah. So, of course, the Chinese are still quite weak on the sentiment level. So it's quite hard to, of course, gauge how the growth can look like. You will have, for sure, some easier comp base that could help to see stronger top-line growth. But I guess, apart from that, it's quite hard to actually explain and, I guess, forecast the top-line growth in H2. And then on the margin, there was, I think, here as well some, I guess, not strong commitment to see that the margin can actually be better in H2, that it can protect the margin in the full year. There was a lot of comment about the Japan market being now a bigger focus and actually having a negative impact on the margin.
Okay, talk me through the. Japan's seen a big currency devaluation. I'm told I can buy nice watches there for well below list prices that I can see elsewhere. Walk me through how that sort of mechanically works and how it translates into the margin story.
Yeah, so of course, right, that the Japanese market is quite attractive on the currency level for many tourists. Of course, the Chinese being the first one to go there. They buy much less domestically and they all go to Japan because it's cheaper to buy luxury goods there. But the issue is that, of course, the OPEX level for Japan is less attractive because there is a much more variable cost base compared to a fixed cost base in some other markets, like Europe, for instance. So when you have stronger top-line growth, you actually also are having stronger OPEX growth. There is no here, improvement that you can see at the EBIT level because of that, because of the cost structure being much more variable. So basically, you don't have that much boost at the EBIT, despite the boost at the top-line level. That's the issue we are seeing right now with Japan. So it's less attractive, despite what you could all think.
What I'm surprised about is their surprise this morning. Like many of these trends that we've been talking about have been present for the last few quarters. Is it just a continuation? It's not getting better. Is that what the problem is this morning, or is the situation getting more difficult?
That's a good question, which I think, again, is still, I guess, quite hard to figure out at the moment. But yeah, I think the issue of today is the lack of visibility and the lack of reassurance, about H2.
Okay.
I think we all expected that Q2 was going to be weak. That was, in a way, quite well known. But we all hope that H2 could get stronger on the back of, again, easy comp base and maybe some better trends on the Chinese, the American, etc. But I feel like right now we are not seeing that as of yet. And again, the margin story here at LVMH was also, I think, an incremental maybe negativity to the story.
If LVMH is struggling, tell me about the rest of the sector.
Yeah, of course, it's a bad read across for the rest of the sector. LVMH being the key anchor name in the space. So, of course, we have seen so far names like Swatch, Burberry already reporting some quite weak numbers. Definitely some miss on the EBIT level for both or on the outlook. Richemont also reported it was okay. But, of course, we still have tonight, Moncler, Kering reporting. So, of course, some quite, I guess, bad read across on the sentiment of the key luxury goods consumer, Chinese especially. And then we also have, Hermès tomorrow. So I guess, it's quite bringing a bit more caution now on what to expect for the sector.
Okay, let's pull it apart a little bit. Kering, Gucci, when does the turnaround come? What are you expecting from Kering?
Yeah, so here we're still quite cautious on Kering. Of course, they are doing this phase of transition at their core brand, Gucci, which I think is still in a way at the beginning of the stage of the transformation. So I feel like Q2 could still be very weak in terms of top-line growth. We expect the brand Gucci to be down pretty much close to 20% negative in Q2. And then they should likely have, a bit more of the product of the new designer in the store from Q3 onwards. So we could hopefully see some improvements in the second half of the year. But I feel like right now in the first half, so Q2, trends could still be quite weak on both top line and the margin, of course.
Anything with a long list, I would assume, would be protected from this. Is Hermès protected from some of the trends we're seeing at the moment because of the long wait list they've got?
I think it is, yes, better protected. Of course, those brands are a bit more exposed to the more, let's say, wealthy consumer cohort, who, of course, are, I think, less impacted by all these macro headwinds we are seeing today. So, yeah, I feel like names like Hermès, could likely do better in terms of the performance at the top line and the margin level. We also have said Richemont was also quite resilient in a way with their more, I guess, higher pricing points exposure.
Let me just throw you a slightly curveball question, which I'm sure you'd be delighted about. French politics. Is there an issue with coming out of the French political story into the big French luxury names?
I think right now it's quite limited impact. I guess the key issue is mostly, uncertainty. You just, of course, don't know what's going to happen exactly. And so, of course, when you don't have visibility...
taxes and all that kind of stuff, do you think that... We think about luxury being French, but actually it's a global market.
Of course, yes.
Does it matter what happens actually in France for these stocks?
I guess to a small extent, yes. Of course, France is a key touristic destination, so I guess you could see maybe less tourists go there if the country becomes much less attractive for, several reasons. So that could be a point. But of course, I think, broadly speaking, France is likely below, in terms of, weight of sales, 10% across all the sector. So I guess the impact on numbers could likely be limited. I think it's mostly uncertainty and maybe the level of attractivity of tourists that is the key issue here.
So do I want to own luxury stocks right now? I know it's a case-by-case basis, single stock to single stock, but broadly, is this a basket that is do I want to have it in my portfolio?
Yeah, it is definitely, I think, a case-by-case story here. But I guess the space usually tends to work when you have, EPS upgrade cycle and, of course, top-line growth momentum, which I guess we really are not seeing that much right now. I think we still maybe are at the risk of seeing more downgrades in the sector compared to seeing upgrades on earnings.
And that's not priced yet.
I think in a way we can maybe still see, again, some negative surprise here. Again, back to LVMH, we were all expecting that, the negativity was going to be finished by H1 and then see better trends in H2. But I feel like now the door is still open for maybe some further downgrades in the second half. So I guess, maybe it's not fully priced in.
That call sounded very interesting last night.
Indeed.
Carole, nice to see you. Thanks very much.
Thank you.
Stopping by to see us. Barclays Head of Luxury Goods Research, Carole Madjo, joining us on what we got from LVMH. As she says, Kering's out. We've got Hermès numbers out tomorrow morning as well. We'll keep an eye on all of this to watch out for as this space develops. We need to probably return back to what is happening with the political story over in the United States. Kamala Harris launching her campaign in the swing state of Wisconsin. We'll have more on how she plans to take on Donald Trump. The polling's starting to get really interesting. We'll dig into that as well. That's next. This is Bloomberg. So, the U.S. Vice President, Kamala Harris, has launched her presidential campaign with a rally in the swing state of Wisconsin. Harris touting her economic agenda and attacking her opponent, Donald Trump, referencing her past work as a public prosecutor.
In those roles, I took on perpetrators of all kinds. Predators who abused women, fraudsters who ripped off consumers, cheaters who broke the rules for their own gain. So hear me when I say, I know Donald Trump's type.
Harris in Wisconsin. Let's get more on what we learned and what we're going to get going forward. Bloomberg's Vonnie Quinn joins us now from Washington. Vonnie, what do we take away from that first campaign speech that she delivered in Wisconsin?
Well, you see those lines that are going to be appearing in the stump speech, I think, Guy, right? The campaign staff will be testing out some of these to see how well they go down. And obviously that cheaters, fraudsters, predators line is going to stay there. She's also testing out some of her ideas. Bear in mind, she has only ever done rallies like this as a vice presidential candidate before, never as a presidential candidate. So she needs to get her feet wet, get some experience doing this and, you know, get the backing of those segments of the electorate that perhaps haven't really gone to rallies before and maybe draw out some more. She has 3.5 months. It's not nothing. It's maybe a shorter cycle than most, but she is testing out some of these ideas. At the moment, we know all of the ideas about building up the middle class, about, you know, adding childcare, family leave, raising the minimum wage. We've heard some of these. We'll know more about her foreign agenda and so on as she starts to look for advisors and as she starts building up more of a staff in the next several weeks. To that point, she continues to campaign. Tomorrow she'll be travelling to Indiana and Texas. And then tomorrow, I say it's actually Wednesday, it is today your time, President Biden will actually be returning to the White House and addressing the nation, which is kind of crucial because we haven't heard from him except for that phone call into the Kamala Harris campaign headquarters since last week, since he went into quarantine with COVID-19.
Yeah, so much over the next few hours coming up. The other factor we need to fold into the mix as well is the fact that the Israeli Prime Minister Benjamin Netanyahu is in town as well. He steps into a really difficult situation. We've now got Harris and Trump. He's going to find that, I suspect, difficult to manage. How will they respond to him? How will Harris and Trump respond to Netanyahu, do you think?
It's funny, Guy, because we don't fully know how the former president, Trump, will actually respond to him, except that he has posted on X that he is meeting him in Mar-a-Lago on Friday. And, you know, you would love to be a fly on the wall for that meeting, right? Because they were huge allies during Trump's first presidency. But Trump was extraordinarily angry with him for congratulating Biden on winning in 2020. And he's also, in recent times, basically sent the message that Netanyahu should finish up this war. You mentioned that he's in town. There is extra security and extra police presence in Washington, D.C. at the moment. Protests ongoing in and around Capitol Hill because Netanyahu does address a joint session of Congress Wednesday. And then he's going to meet Biden on Thursday and meet Harris at a certain point separately from Biden and then meet Trump. So Netanyahu will be trying to feel out the different positions of the various leaders. Biden, for his part, we know, wants a permanent ceasefire, perhaps preceded by a temporary ceasefire. But every time he says that's imminent, it hasn't come to fruition.
Thanks, Vonnie. Vonnie Quinn updating us on the latest on US politics out of Washington, D.C. Let's talk more about what is happening in the United States. The US Secret Service Director Kimberly Chittle has resigned after taking responsibility for the security failures at the rally where Donald Trump was shot. The Deputy Director, Ronald Rowe, will lead the Secret Service as acting director going forward. Both Republican and Democratic lawmakers called on Chittle to step down. The French President, Emmanuel Macron, says he won't pick a new Prime Minister before the end of the Olympics and doubled down on his call for a political truce following weeks of turmoil in France. Meanwhile, Politico is reporting that France's far right has signalled it's ready to support the far left to repeal Macron's pension reform. And Ukraine's foreign minister has arrived in China to discuss Beijing's possible role in ending Russia's invasion, the first visit to China by a senior Ukrainian official in 8 years. Beijing has put forward proposals for a peace initiative that would include Russia at the table. What we're going to do next, it has been a huge morning for European bank reporting. Deutsche Bank, BNP Paribas, Santander reporting. We're going to hear from their CFOs and get the latest on how the markets have been reacting to the results. That's next. This is Bloomberg.
Yes, we have very solid results. We basically have that on the back, amongst others, of all the cross-selling that we do. I am cautiously optimistic of what you see in the Eurozone. Inflation is tapering off. Therefore, the ECB is also reducing the interest rate. So the economy is picking up. And that's basically fueling a positive spiral.
The second quarter was absolutely a continuation of the first. So momentum in the businesses, on the revenue side, also just client engagement, market share growth. For this year, I think prudence would dictate that we step back from seeking a second repurchase authorization.
I think we are building a very strong momentum at Santander through a combination of a very positive evolution of our 5 global businesses. What explains our strong momentum today, again, is the combination of more customers and simplification, digitalization, automation, keeping costs flat.
CFO Central, the CFOs of BNP Paribas, Deutsche Bank and Santander speaking to Bloomberg this morning. Let's talk about the various share price reactions we've seen for those stocks. As you can see, Deutsche under significant pressure after its numbers. Paribas is interesting. It's soft as well, despite an absolutely awesome performance by its equities team. Santander is up. Traditional banking delivering the efficiency that has been driven through that business really beginning to drop down. Unit credit down by 1.7%. So that's what the banking story looks like. Euro-dollar looks like this on the back of the dismal data we've seen, particularly out of Germany on the manufacturing side this morning. And let me just wrap things through into what we're going to see in the United States a little bit later on. Tesla and Alphabet out with numbers last night. Both stocks are down. Tesla pre-market down by 7%. The fair value on the S&P this morning down by circa 0.5%. The brief is next. Danny Berger, Manus Cranny in New York. This is Bloomberg.